Conventional financing. Hi, Kevin. I'm Kevin Jefferson, the People's Lender, NMLS number 1433853. So we're going to talk about conventional financing in 2022 and dispelling some of the myths on conventional financing. So one of the biggest myths with conventional financing is that you need 20% as a down payment. You can put down 20% if you'd like. However, you don't have to. If you're a first-time home buyer, the minimum down payment on a conventional loan is as low as 3%. If you're not a first-time home buyer, you still don't have to put down 20% on conventional financing. You can put down a down payment as low as 5%. This is on single-family homes. If you are interested in a second home using conventional financing, then you need to put down 10%. If you're looking for an investment property that is a single family home, you're looking at putting down 15% of the sales price. Now, conventional will, like I said, allow for you to do investment properties. And as you go up in the amount of units, so you can do from 1 to 4, as you go up in the amount of units, there's also a higher requirement for the down payment. So on a duplex, you're putting down 20%. And on a 3 to 4 family, you're putting down 25% using conventional financing. Now, 20%, when we go back to 20%, what that will do is that will help you not have to have mortgage insurance. Mortgage insurance is insurance that Fannie Mae or Freddie Mac, who are the largest servicers of conventional loans, use to help cover the loan in case of some type of default on the loan. There are 2 programs that are affordable programs. Home Ready is a Fannie Mae product, which is based off of household income and 80% of the area median income. So depending on where you live, your income can exceed 80% of the area median income. If you don't exceed 80% of the area median income and you qualify for a Home Ready or Home Possible product, typically your interest rate is lower and your mortgage insurance is lower as well. So those are Fannie Mae and Freddie Mac's a way of having affordable housing products for you. It's not a no down payment, but it does lower the cost of interest rate and mortgage insurance, which helps in payment and helps you qualify for a little bit more. So let's go into credit. With conventional financing, you can have a credit score as low as a 620. Now, let me preference that. Getting qualified with a 620 credit score for conventional financing is pretty hard, but it is possible, and that is their minimum score. Where you start to see a little bit more leniency and better interest rates is when you have a 680 credit score or higher. And when you get to 740, that's the max. Like you could have an 800 and not get better rates. So 740 is the max on the credit score. Now, what people don't understand is all lenders are required to use the middle score. So let's go with the 620, the 680, and the 740 we just discussed. The middle score for that borrower is 680. So if that borrower has a 680 middle score, that's the score determining how they can get qualified for. It doesn't matter whether it is Experian, TransUnion, or Equifax. The middle score is the score that's not your highest. It's not your lowest, it's the one right in the middle. And as another misconception is that they take all 3 scores and average them. They don't average the 3 scores. They take the one that is in the middle in terms of scoring wise to be conservative. Now, Fannie Mae will, they've come into play where they will average the middle score if there are multiple borrowers on the credit report. So they will use borrower A's 680, and they will use borrower B's 620 and average those two out. Now those are utilized for, those middle scores being averaged are utilized to help you qualify for a Fannie Mae conventional loan. However, that is not the score that determines your interest rate and mortgage insurance. The interest rate and the mortgage insurance still is determined by the lowest of the two middle scores. Okay. What people also have to understand is the difference between conventional financing and FHA financing is conventional financing tends to want higher credit scores, less credit issues, and they're very conservative. So they like to see a mix of at least 2 years of credit history. They like to see 12 months of no late payments and no collections. They also want to make sure that the borrower is qualified. So they want to make sure they have assets and sometimes possibly reserves. They also want to make sure that the borrower doesn't maximize what they utilize of their income, something in their debt to income ratio. So they don't go as high on the debt to income ratio as FHA financing. You can get as high as 50%, but you have to have a real strong credit profile, strong credit score, and strong assets in order to get to that 50% debt to income ratio. So you're probably teetering around the 45%. And the lower your score and the less assets you have, the lower it typically go for you getting approved, based off the debt to income ratio, because they're very conservative and they want to make sure they don't get this loan back into their fold where they have to foreclose on when it's been foreclosed on and they have to resell it. Now, with that being said, if you've had some credit challenges in the past, conventional financing does still allow for you to be able to get financing. So example, if you had a Chapter 7 bankruptcy, 4 years from the bankruptcy, you are allowed to qualify for financing. If you did a Chapter 13 bankruptcy, where Chapter 13 bankruptcy is where you paid off your debts, you will have 2 years after it being discharged. Discharge means you've paid it and then 2 years has went by since you paid it and now you can qualify. Everyone doesn't always finish their Chapter 13 bankruptcy. So if it has been dismissed where you started it and you stopped, it is 4 years from the date that you've been dismissed. If you have had a foreclosure on your credit where you owned a home previously and the house was sold and transferred, it is 7 years after the property has been transferred. If you had a deed in lieu of or a short sale, so a deed in lieu of is when you've owned the home and you've signed it over and given it back to the mortgage company because you can no longer manage it and it stops you from going to foreclosure. Or if you did a short sale, and what a short sale is that the property didn't sell for what was owed on it. Example, if you owed $300,000 on the house and it sold for $250,000, then that is a short sale where the bank is shorted funds. Those two situations, you can purchase a home with conventional financing after 4 years. If you have a IRS debt, and this is another huge misconception, if you have an IRS debt, it doesn't stop you from purchasing a home. What you need to do is get on a payment plan. And then once you're on the payment plan, we just add that payment into your debt to income ratio. So example, if your payment plan is $250, we just take that payment and add it into your debt to income ratio so it's factored in as debt. So let's discuss mortgage insurance. So mortgage insurance, as I previously said, is required on the loan if you put down less than 20%. However, with mortgage insurance, there's no upfront mortgage insurance like FHA. There's just a monthly payment. How the monthly mortgage insurance is calculated, you can shop it around with different mortgage insurance companies, which is done by the lender, and see if whatever you get a better rate. They all have a different appetite for the level of risk which means based off the credit score. So based off your debt to income ratio and credit score, those are two determining factors on how much your mortgage insurance will be. Now, don't fret if you haven't put down 20% on your home and you want to get rid of mortgage insurance, because sometimes it can be, a couple $100 payment. After you have 20% equity in the property, you can request for the mortgage insurance to be removed by the lender. Once you get the 22% of equity in the property, then the mortgage insurance should automatically fall off. In terms of student loans, now student loans is huge. There's $1.7 trillion in student loan debt. There's 45 million people with student loan debt. So it's hard to get around. So the guidelines for student loans are for Fannie Mae, you can have a payment, and we use that payment into your debt to income ratio. Or if your student loans are deferred, we can use 1% of the balance. If your student loans are $100,000, 1% of the balance is $1,000. So we would add $1,000 a month into your payment. That would be based off of Fannie Mae. Freddie Mac has a slightly different rule. Freddie Mac, if your payment is 0 or deferred, they let you use 0.5%. So on that same $100,000 student loan debt, as opposed to it being $1,000 a month payment, it would be $500 a month. Now, I did a video that goes a lot more in depth on student loans for conventional financing. You'll see it in the notes below. You can click on it, take a look at it, and you get a better view of exactly how the student loans are calculated for conventional financing. And closing costs. Closing costs is what it costs to close on the property. This is where when in the beginning, when we request bank statements, we check your bank statements to make sure you have funds for closing costs. Everyone doesn't have the required closing cost in their bank statement. They could pull it from 401k, or they could get a gift from a family member. The seller also has the ability to pay for pay some of the borrower's closing costs. If the borrower puts down less than 10% for closing cost for down payment, the seller can pay up to 3%. If the borrower puts down 10%, the seller can pay up to 6% of the sales price. And if you put down 25% or more, the seller could pay 9% of the closing costs. Now, on investment products, no matter what you put down, the seller can only contribute up to 2% of the sales price. Keep in mind that as much as you ask for the seller, that comes from their side. And when you put closing cost assistance, especially in sellers markets, when you put closing cost assistance in, that a lot of times makes your offer a lot less attractive. I hope you gained some valuable information from this. If you could do me a huge favor and like this post, if you have any questions pertaining to conventional financing, definitely ask me questions down in the comments. Thank you and have a great day.